Where you really start to get into the accounting area, though, is over on page 12, where we start to talk about the accounting equation. And the accounting equation is really kind of where accounting starts to go away from being just math and numbers to being a language. Because we talk about something called assets, liabilities, and then something called owner's equity. And here they call it stockholders' equity. Make sure I use the right term. And the accounting equation is where we're trying to go through and group together what the accounting transactions that occurred during a period of time are all put in one place. And so when we talk about assets, we go through and we talk about assets as being a resource a company is going to be able to use. It's something it's going to be able to utilize for its benefit in the future. And so I like to think of an asset as something that a company owns. And that might be cash, that it's going to use to pay for bills. It might be inventory that it's going to sell to customers in the future. It might be a truck that it's going to use to make deliveries, but it's something the company is going to utilize. Liabilities are obligations to pay, a promise to pay something in the future. So I like to say that's what the company owes. And so you have a promise to pay something in the future. Maybe you've borrowed money, so you have to pay the bank back. That's a liability. Or another word for that would be payable. You have to pay it in the future. Maybe you have employees that work for you and you haven't paid yet because you haven't got to the pay date. You only pay them every 2 weeks. So you have to go through and you have to calculate how much you owe them at the end of the month because you don't pay them until the first part of the next week. Maybe you have taxes that you owe to tax authorities. All those are obligations a company's going to have to pay in the future. Okay? And these items occur whenever there's some sort of an economic transaction that's occurred, where there's an exchange of value. Like either you've received something and you have to pay for it, or you promised to do something, you're obligated to take care of that. The difference between those items is what I like to call, think of it as net worth, the value of the company. You could go through and you could change the equation around and say assets minus liabilities equal stockholders' equity. If you took everything that the company owned, turned it into cash, paid off everything that the company owed, so it didn't owe any more liabilities, what would be left over would be the net worth of the company. Okay? And they talk about this on page, they go through the expenses and everything and the liability definitions on page 12 and 13. But what's really important to keep in mind is that basically the assets are what a company uses to operate in its business. It gets those assets from one of two places. Either it gets that from the owners putting in the value, we call that the residual value, or it gets it from the liabilities that it's incurred. So that's one of the two ways that a company is going to be able to get an asset. So the reason we do this equal sign is because that has to do with the concept of double entry bookkeeping, where we're going to make sure that every time we change something in one account, it's going to be balanced on the other side. So if an asset goes up, if you get a truck, you got that by either borrowing money, by somebody contributing it, or you might have got it by using cash, which truck value went up for the asset, but the cash went down. So there's always going to be an offset whenever we're using transactions, and this accounting equation kind of sets that up with the equal sign.